Hello, I'm Cathy Kuhn. I'm a CPA with Cathy Company CPAs, and I'm here this evening to talk about financial controls for your association. Before I get started, I did also want to just put in a real quick plug for WSCAI. This is what I've learned over the years being involved in this industry. This is definitely one of those industries where the more you think, the more you're in the industry, the more you realize what you don't know. And you think you keep learning, and you learn more and more and realize there's a whole lot about this industry I don't know, and I learn something new every day I'm involved. And so CAI has such outstanding educational opportunities. We have all of our staff in our firm go, and we've really all benefited from WSCAI, as does our clients as well. So before I get started, does everybody have an orange handout? And my colleague Lisa in the back here has one for you if you don't have one. I don't have a PowerPoint outline tonight, so I will be just talking from this orange handout. And the other thing I wanted to find out, just a couple comments as well, is we learned at the beginning who you are and who you're with. I wasn't sure when I listened to the names if you're with a homeowners association or if you're with a condominium association. So I'd be curious in this room how many people are with condominium associations. Okay, and then how about with homeowners associations? Okay, so we have just about an even Steven there, and that's very helpful because some of the things I'm talking about do apply differently, and you'll see that to HOAs and condos. Be sure to ask me any questions that you have as I go along. I really want this to be very interactive, and so as you think of something, we don't need to wait to the end to ask me questions. Feel free. I think I've got maybe 25 minutes, half an hour to talk. I think people learn more when they hear some of the other questions that all of you have. Don't be intimidated by the camera. I know that's a little different. It is for me too. I'm sitting there staring at a camera, but let's all just kind of make it like we're all here together and able to talk to each other and converse back and forth. So. Also, a lot of what I'm talking about tonight, you're going to see that I'm very much doing a 30,000-foot flyover. Most of the topics that I'm going to touch on could easily be, and I'm sure Lynn would say this as well, Dan too, that it could be another hour, 2-hour class on every single topic. So one of the things I wanted to refer you to is our firm does have a website. It's www.HOACPA.com. You'll see it at the bottom of these materials that you have. The only reason I reference that is we have probably 30 or 40 frequently asked questions, FAQs, on our website. So a lot of the things I'm talking about, there will be a specific FAQ on the site with a lot more information. Also, never hesitate to give me a call. You'll see my contact information there as well. We like to be definitely a resource to the industry, so feel free to contact me personally as well or talk to me after the class tonight. A lot of what I'm talking about tonight is planning for the unexpected. If things went just the way they're supposed to be, I don't think I'd have nearly the occupation or the job that I have. So a lot of the things that happen are because they're unexpected. I don't know about you, but when I was driving up here tonight, a sign on a hotel said it was 70 degrees. So it was blue sky, 70 degrees, 6 o'clock at night, and it's October 20th. I don't know about you, but that was unexpected today. So those are some of the things that I think come up all the time in this industry, are the things that are unexpected. So getting to the handout here then, one of the things that I always like to start out with, and I'm sure those of you who have been to CA Day or other CAI events, we always talk about the concept of your association is a multi-million-dollar business. And I don't think that concept ever gets old because it's something that's very important to think about, and maybe one of the key things that I want to emphasize to you tonight. If you think of nothing else financially when you walk away tonight, you're running a multi-million-dollar corporation. Whether it's the total value of the assets that is your HOA or your condominium, whether it's the value of the assessments that are running through your association. There may be $50,000 a year, there may be $500,000, there may be a couple $1,000,000 a year in assessment income running through your association. There may be special assessments that come up. There may be lawsuit settlements. There's a lot of money that can be running through those associations. How many corporations do you know that are completely run by a volunteer board when there could be millions of dollars running through it a year? So think about that concept. Think about the corporations you know out there and how many of those are run by volunteers. Not to say there's anything wrong with any of the volunteers here. I'm sure you're all highly competent, but that's really sort of mind-boggling if you think about it, just that concept alone. Another thing I like to talk about, and again, those of you who've heard either myself speak or other people from our firm, don't cheat by giving us the answer here, but we, on here where I said survey says, our firm a few years back did a national survey through CAI, and the question that we asked was, how many minutes does your association spend at each board meeting on your treasurer's report? I'm curious, just in this room, before I answer that question as far as what our national survey said,
about 1 to 2
how about
minutes.
some feedback? And you said
1 to 2 minutes to just read off some figures.
Okay, so I'm hearing 1 to 2 minutes. Okay, is what your association. What about you?
0.
0. 0 minutes per month spent on your treasurer's report. Why would that be?
They don't meet each month either.
So when they meet, though, why would you say that your association doesn't spend any time on the treasurer's or the financial report?
They don't understand. They're not aware. I don't think it's anything done purposely. They just have no idea.
Any other feedback?
We spend a half hour.
Okay, now that's more, of course, it's near and dear to a CPA's heart to hear those kind of things. So, and that would be more than what we heard, but certainly something that would be important. So, to answer the question, the national survey, and these were hundreds of associations that were responding, was about 3 minutes, was the average. 2 to 3 minutes is what we found in that national survey. So again, if you stop to think about it, and here I say there's more time spent on the 4 Ps, fill in the blanks, pets, parking, pools. Think about all the other things, and I'm not saying that that's not important, that are not important to your community, because all of those things can be very important. But again, think about that, talk to your boards about that. How much time are we spending on that monthly report? It doesn't have to be something where someone's just rotely reading a lot of numbers off of the financial statements. They can make it a little more interesting than that. They can highlight the interesting things to keep everybody awake. But chances are there are things happening in the community every month from a financial perspective that would be important for that board to discuss, to be aware of, and to be acting upon and documenting, as both Lynn and Dan talk about, documenting for the next month or the things that are happening in the financials. So consider that, talk to your boards. Again, here we go with another question I have for all of you is, how many here are board presidents? Okay, and then how many of you are the treasurers? Okay, so again, and of course other board members as well. So a lot of these concepts are important for the treasurer, but they're really just equally important for the whole board. And a lot of times I hear other board members say, well, I'm not the treasurer, so I really don't have to think about that, or I don't have to deal with the financial affairs as much. And I would say, please, you know, let's think about that a little bit differently. The financial statements are the responsibility of the full board. And so that's something to think about, is you want those checks and balances in place, that more people, really than just the board treasurer, is aware of the financial situation. I met with a board actually just yesterday down in the South County, and they had a treasurer, a longtime treasurer on the board, that was aware of everything. This is an organization that has 3,000 units, so it's a relatively large HOA. The treasurer had been involved for a long period of time. She left the community in July of this last year. We have almost a new board in place, and this board knows very little about the financial affairs of this community. There was actually way too much responsibility and authority vested in that one person, and so now there are some real questions coming up about how certain things were handled, and there's a lack of knowledge on the current board, so something to be aware of. Internal controls here, I say, are important in associations. Would anybody here like to venture a definition for me of what they consider to be the definition of internal control? Any takers? What does that word mean? What does the word internal accounting control mean, or what do you think that means in your association? Dan's gonna, thank you, Dan. Okay.
Check and balance? Or what?
Yes, so Dan said checks and balances. That's a very good way of putting it. So an internal control is very simply and easily put is those checks and balances that you have in your organization to make sure that some things happen financially that are or don't happen financially that are unexpected, that you would not want to occur. Another way of putting it is that the example I gave before with the one person probably having too much control or authority, you always just want more than one person involved in the financial function. That's called, in accounting terms, segregation of duties. You want at least two people aware of what's happening, maybe more than that. If you have someone who's handling the cash receipts, they're probably not the same person who is then posting to your accounts receivable or having the ability to write off accounts receivable. Same thing with then even the review of the financial statement or the cash reconciliation. Somebody involved in cash would not be the person to reconcile the cash account. And I know that's harder in smaller associations, or if it's a self-managed association. It's not always practical, but do what you can to make sure that you have more than one person involved in the various financial functions. And then if you can't do that, make sure your board is reviewing those monthly financial statements, because that in and of itself is an internal control. So don't ever forget about the fact that the board is the internal control or one of the internal controls. The other thing I did is I attached on, let's see, what color is that? It says the 10, I guess it's the next yellow sheet that you have there in your handout. It says the 10 Commandments of Internal Control. And again, this is just something on our website that you could also refer your other board members to as well. But I'll just quickly skim through this. It says, thou shalt not sign blank checks is one of the more, I think, obvious things. And also to deposit your cash receipts in a timely manner. I was at a board meeting, I guess a week or two ago, and the board was questioning the fact that the manager, they have employed a professional manager, and the manager wasn't depositing their cash receipts any more frequently than every 2 to 3 weeks. We really didn't think that was appropriate. The manager thought it was because they deal with a lot of different banks, and they said, well, we deposit on Tuesdays with XYZ Bank and on Thursdays with ABC Bank, and so we're on a regular cycle, and their bank is the second and fourth Tuesday of the month, or however that worked out. This is a manager that I think probably manages 45 or 50 associations, but that's just something that we said to the board was, no, we think it's not appropriate, and every really 2, 3, 4 days, depending on the size of your association. In some cases, it ought to be every single day that the money is being deposited in the bank. So something to think about. And I won't read all of this to you. It's just something to be aware of. Point 5 says, always have verification behind your paid invoices. So if things that are being paid, make sure that there's authority as to the fact that everybody agrees that should be paid, that that's a valid expense. And then number 6, that you need to have 2 board signers on reserve withdrawals. That's actually a Washington law for that question.
On reserves, when you spend the money for a reserve capital project maintenance, I have been told that information should go into the minutes. It should be brought up at the board meeting, then the decision made, and then they say, we'll be spending this money, we'll have a contract for such and such.
Yes, the question is, should reserve expenses, when they are approved, should that be documented in the minutes? I don't, Dan, you can correct me if I'm wrong, I don't believe that's a Washington law requirement. However, our firm and others in the industry would absolutely say that we would recommend that all reserve expenses be documented as approved in the minutes. That in itself is a good internal control. When we come in and we do the annual audit of the association, that's one of the things we always go to are the board minutes. We want to follow that audit trail to see that the amount the board approved was actually the amount that was spent, because sometimes that's not the case. And there are reasons that are good reasons for that, but there are reasons that are not appropriate for why that happened, whether it be an additional kickback to a vendor or other arrangements that were not appropriate in terms of what the board authorized be spent versus what actually was spent. And so that's a good internal control to have that documentation. Also protects the board, I think, in terms of that they knew and they authorized the expense. Let's see, yeah, so the emphasis would be there to make sure that you always have the 2 board signers on reserve accounts. And what else do I want to emphasize? Number 8 here says, thou shalt require approval of write-offs of accounts receivable balances. That's, of course, quite a hot topic right now in the industry, unfortunately, because of the number of delinquencies and foreclosures that we're seeing. But that is an internal control to make sure that the board is aware of accounts receivable that are being written off as bad debts. If you have your accounting department doing that and the board is not aware of it, potentially there can be fraud that occurs even with the accountant or whatnot, because they are able to show it as a write-off and collect the cash instead. And it really wasn't a true write-off of accounts receivable. So you always want a board policy as to who has authority to write off accounts receivable, and you want documentation as such as well. So something to think about. And then number 9, thou shalt review all bank statements and reconciliations at least quarterly for all bank accounts, including CDs. We put that emphasis on all for a reason. Very often we see that boards are not seeing the reconciliations or the CD bank account statements. And that's sometimes because the bank doesn't provide them so often. We think a bank ought to be providing that information at least quarterly. We'd prefer monthly that the board look at that, but if quarterly, that's fine too. But very often you'll see that banks don't provide that information quarterly, and we believe that that's a very important internal control. Quick story, in our practice a number of years back, in our California practice that existed at the time, there was an association manager, and this is a $250,000, $300,000 CD, that realized she needed some money, thought that maybe the association wouldn't mind if she borrowed a little bit from that CD that the association had. For whatever reason, she had signature authority on the CD and started to borrow from the CD and then put the money back and borrow from the CD and put the money back, borrow, put it back, borrow, didn't put it back, couldn't afford to put it back. And so I'm not saying, I don't mean to scare you, that that's, you know, we haven't seen that very frequently, but those things can happen. And so boards will say, well, we get the monthly bank statements for the operating account or the reserve savings, but we don't get the CDs, you know, because the bank doesn't provide them very much. And we say, do whatever you need to do. Make sure you're looking at those, whether it's quarterly or whatever is preferable for you that way. And I guess I lost my train of thought on something else I was going to say just related to that, but I guess it's just important to make sure you're getting that information quarterly or monthly. So, I know what I was going to say is they say, well, our bank doesn't do it, and what we say is, if you thought about changing banks, we just think it's that important. So, and then number 10 we already talked about, but just to make sure you're getting either monthly or quarterly financial statements, we prefer monthly, but of course if it's smaller or not as frequent, quarterly is fine too. So. Back to the front handout, the orange handout. Quickly, I will go over, I call it a tale of 3 fraud stories. So a couple of other stories for you. One I like to call, let's not pay our assessments for a year. And this is a true story. We really don't make these things up in our practice. But one year, the board president and the board treasurer decided that yes, they do work very hard, which is true. But because they work so hard, they really shouldn't have to pay assessments that year. And that's fine, except that nobody else knew that or there wasn't any authority to do that. So that happened, and that went on for a year before it can be caught. And I'll get to in a minute how these things can happen, but that happened. Another one I call, how many laundry room doors do we need? And that's another true story where this was, again, a very large HOA, but they were purchasing a number of doors for their various laundry rooms. And when they were doing the audit, they looked at, well, why would it be that there appear to be 30 or 40 purchases here for laundry room doors, and by my count, I think there's 15 doors. So again, that would be an example of a phony vendor where there was somehow an ability on the part of the manager, accountant to direct those payments to a phony vendor by documenting phony invoices. And then the board maybe, or whoever was authorizing the payment wasn't paying enough attention there or thinking about disbursements that they were authorizing. And then the last one I call anyone up for a trip to Monterey. This is Monterey, California. And this was a situation where the association manager, this was a large on-site manager, had the association credit card and was able to take a trip to Monterey on the association credit card. Didn't really have a whole lot to do with association business. Took a while, that was caught as well. So again, just thinking about controls over credit cards and authorizations and that type of thing. So when I say on here, how can this happen? And I say there's the cash method of accounting and there's the accrual method of accounting. The president and treasurer story that I gave you with respect to not paying assessments, one of the reasons that happened was because the association was on the cash basis of accounting. And the difference between that, again, that could be a whole class. But some of you may be on cash, some of you may be on accrual. Cash means you just record your receipts when you receive them and you pay your expenses when you pay them, like your checkbook at home in your personal account. And the accrual method is a little more like maybe think about your personal credit card where you're recording revenue when it should be billed by the association every month, and you're recording expenses when you incur them, not when you pay them. So if you had some security services in a given month and they occurred on January 15th and you didn't pay it till February, you're still going to record that expense in January as an accounts payable. When you bill your members, you bill all of them on January 1st and you record the revenue then, regardless of when you collect your cash receipts. So in the case of the manager or the president and the treasurer, with the cash receipt method that was being done, because they didn't record accounts receivable and billings, they had really no way of reconciling, okay, we have 50 units, so it should be 50 units times $200 that month, and that should be our revenue in the books. And so when you're on accrual, it keeps you accountable, because if that money, the money gets billed and recorded in the financial statements, and if you don't collect it, there's an accountability there. What happened to these two assessments for the month they've been billed? How come we're not collecting them? Shows up on your aged receivables report as a delinquency. Now there's a follow-up mechanism because you used accrual basis accounting. So I'm curious in this room again, how many of you would be aware of whether your associations, I'll say first on the accrual method, are you aware of your financial statements, or is that
we have a property manager, and he is on the cash basis. Okay. And I've written to him about this, saying I don't think that's the best way we should do it.
And you don't, okay, I got to repeat the question. You have a property manager and your financial statements are therefore on the cash method. You've talked to your association manager about it.
I've given a letter
to the, you've given a letter to the membership?
Well, we have a meeting tomorrow night.
Okay.
And I sent the letter to the manager yesterday, and he replied that he was on the cash basis. And so tomorrow night I'll bring it up at the board meeting.
Okay, so just to repeat that, then they're going to be dealing with that at a board meeting, but the manager is replying that yes, they are on the cash basis. One more question I have for you is, did you say you were an HOA or a condominium associate? Okay, so the Washington law for condominium associations, we won't get into old act versus new act, but basically the Washington law says that financial statements for condominium associations shall be on the accrual method. And more importantly, when you are preparing your resale certificates, those financial statements shall be on the accrual method, or at least with back to 4 months. So whenever you're preparing your resale certificates, you need to provide a financial statement within 4 months of prior to that, and on the accrual method. And again, Dan can correct me if I don't have that quite right with respect to the Washington RCWs and the Washington Condominium Act. But that's something maybe to talk to your manager about, would be there. It really is a matter of law, and especially with resale certificates, And it's the law, but it's also just good practice to be on the accrual method. So something to think about. And then I said, next here, I said, at a minimum, consider strong board oversight of the treasurer. So I've already talked about that, but especially if it's a self-managed association where you have maybe even a member who is doing the books for the association, keep that in mind, that you would want very strong oversight of that one person who has probably almost 100% control of the financial function. We really recommend, if you choose to be self-managed, we recommend you think about hiring an accounting, a bookkeeping firm, of which we are not, but we know of other firms who do a very good job out there of bookkeeping, who would outsource that for you and then keep that function separate from your association. For a whole lot of reasons, it makes sense to maybe outsource at least that function. Then I say there's a gap in how much GAAP is used in the state of Washington. GAAP, GAAP refers to generally accepted accounting principles. It's sort of what us accountants live by. And I have a handout, and it is the sort of purple lavender colored handout there. And it says GAAP in Washington state law for community associations. We're a little limited on time tonight. I'm not going to go into all the details of that. This also, again, all this information is on our website. But I go into, if you're in what's referred to as an old act condo, versus, which would be pre-1990 formation, versus a new act condominium, versus those that are under the Washington Homeowners Act. There are different levels of GAAP required, and there are also different requirements with respect to whether you need an annual audit. So won't get into a whole lot of that today, or just due to limits of time, but be aware that you need to be thinking about whether there is a Washington law for your association with respect to requiring an audit in your particular situation. Afterwards, I'd be happy to answer more questions about that as well. And then I say association accounting is quite complex. So again, this is just serving as a means to remind you that it's very good to get educated. Think about using outsourced accounting and or professional management for the entire financial function, and as otherwise. There are all kinds of things to consider. If your association has to go through a special assessment, that's very complex accounting. If you have to borrow money because you have the special assessment and you're guaranteeing the loan with your special assessments, that's very complex accounting. Your reserve funds, keeping your reserve funds completely separate from your operating funds. By Washington law, you need to be segregating your reserve cash from your operating cash, and I imagine all you are aware of that. So again, there are things like if you have a budget that says we're going to allocate $100,000 this year to our reserve fund, you need to make sure that you're actually moving that money over to the reserve fund. There are, again, Washington laws for condominium associations having to do with if you're borrowing money from your reserve account, how that should be paid back within 24 months, notification to the membership, documenting your plan for repayment, making sure that any borrowings that occur, and I would never recommend that, but if they have to occur, that you have a plan for how that's going to be paid back, that you've thought about how we're going to budget in the next year to pay that back. So again, just lots of things. It's amazing how complex community association accounting can be. Every day we scratch our heads and say, I wonder how we're going to handle that, to tell you the truth. So just we see something new every day and what's going on out there. Going on here where I say be a skeptic, and that sometimes then using your manager, the manager really can be the bad guy for your association. They can be that separation you need so that you don't need to be the bad guy with your neighbor. And what I mean by that is we've seen associations that want to trade with equity securities for their investments. Chances are that's actually against their governing documents, but it depends. We've seen that though. We had an association that received, I think it was about $5 million in a litigation settlement, $5 or $6 million. They got into bond funds a couple years ago, and within about a year lost, I think, between $300,000 and $400,000 in that 1 year. So again, investment policy, extremely important. We don't have a policy on our website right now, but we get a lot of questions about that. And literally in the last week, we've been working up or talking to bankers and other investment professionals we know, because we're really not investment professionals ourselves. But we've talked to people we know, and we're going to put 2 or 3 different investment policies on our website, because we get a lot of questions about, do you have a sample of that? How do I get some help on a good investment policy? So. And then I made the comment here, we hear, let's not raise assessments. So hopefully all of you know that it's good practice probably to be raising your assessments every year. You need to be the bad guy. That's okay. You're the board. You look a lot worse 5 years down the road if you never raised assessments, and now you need a special assessment. So those are the things to be thinking about as a board member. Lynn touched on your annual budgeting process. And that's what's happening in associations literally as we speak right now. They're all gearing up for their annual budget ratification meeting. And that's, again, a whole topic and a 4-hour class in itself through CAI. But important to be looking at those trends, looking at your financial statements. I'm getting a lot of questions, a lot of calls right now because board members are preparing their budgets, which is forcing them to look at their financial statements. Maybe they hadn't looked at them a whole lot this year. Now they've got to be looking at their financials to help them predict what they think is going to happen next year. So it's a good tool to force you to look back, look at what's happened, look at trends. Think about bad debts, of course. It's something that's out there that we've got delinquencies, we've got foreclosures. Be sure you're budgeting for potential bad debts in your association next year. And then the last comment I make here is I say how taxing, that associations must file a tax return. Some board members we talk to are not aware that just because you are a Washington nonprofit corporation does not mean that you shouldn't be filing an annual tax return. Again, a lot of information on our website. There's a whole lot of intricacies to the tax law for HOAs. But it is a requirement to file an annual tax return. There's a couple different kinds you can file. It's something to think about if you have a new association. It's got to be filed from day 1 of incorporation regardless of financial activity. So something, again, to be aware of. I'm going to quickly look to see if I've covered everything that I gave you in the handouts here. I'll point out the gray checklist here, which is called year-end checklist for treasurers. So as you approach year-end, something to think about and to be looking at if you are the treasurer to get your association ready for year-end. And then this was a good article, this last white handout here is something we came across just within the last month. We have someone we know of by the name of Dr. Ronald Stone. He actually is an accounting professor down at Cal State Northridge. And he's a CPA and a certified fraud examiner. So we actually had dinner with him at a conference we were at in LA a couple weeks ago, and he has fraud stories like you would not believe in that area, particularly $1 million, $2 million, larger than that association fraud incidents that are occurring in Southern California or have occurred. I thought he wrote an excellent article. I think it's only a couple pages long, and he gives you 10 different things to consider that I thought were very good in terms of some things to consider to help your association put in place the controls you need to help prevent fraud in your association. It is a California article. There are some mentions of the California Civil Code, so not relevant, not applicable. Don't get confused by that. It's got nothing to do with Washington law, but he's got some good points in here. So, and with that, further questions? And I'm also free to talk afterwards, of course, as well. So, okay, thank you.